All right, guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have a presentation with Darin Newsom from DTN IQFeed. This webinar is part of our June 4-year anniversary. All month long, we've had some really fantastic webinars, and included in that has been some really fantastic prizes. Today, Darin's going to talk about market structure and analysis. Some of the bullet points are a top-down look at market structure, analysis of popular commodity index, grains, and energy products, technical and fundamental approaches, and an emphasis on risk management strategies. Also, I want to let you know that part of this webinar includes 4 prizes from DTN, which is a 4-month subscription to their data feed, IQFeed. So you're going to want to pay close attention to what Darin covers today, because the quiz questions at the end are directly based on the content covered today. Okay, and with that, we also have Robert here from IQFeed. Robert is active in the forums. He's the one that you guys see pretty often answering questions about IQFeed. So what I'm going to do is turn Robert's mic on, if I could talk, and I'm going to turn control over to Darin, and he's going to share his screen. All right, Robert, you should be good to go, and Darin, you should have the option to share the screen.
Well, hi everybody, and welcome. First, a big thank you to Big Mike for inviting DTN to participate. Congratulations on your 4th year of excellence. We're very proud to be associated with Big Mike's group. Today's speaker is DTN Senior Analyst Darin Newsom. Darin has almost 25 years of experience analyzing commodity markets and developing risk management strategies. He's also the creator and guiding force behind DTN's 6 marketing strategies. Besides DTN, his article and commentary are also consistently featured in industry publications such as The Progressive Farmer, Trader Planet, and Commodity Now magazine, along with multiple newspapers and radio stations throughout the country. He's a regular guest on CNBC and the Iowa Public Television program Market to Market. Darin's a senior member of DTN's own newsroom, which has won dozens of awards for its coverage of worldwide ag and energy markets. Continuous market coverage from our newsroom, 30 reporters and analysts, is available through DTN IQFeed, as well as our other software, web, and Apple iOS-based platforms. And with that, I'll turn this over to Darin.
All right, thanks, Robert.
Thank you, Robert. Appreciate the intro. Again, I want to welcome everybody that's joined us this afternoon. Really looking forward to this. Taking a different look at the market. We're going to kind of go through how I like to take things apart, what it tells me about the markets, and once we better understand what we're dealing with as far as any particular market goes, it helps us trade it better. Maybe it gets us into a better position. Maybe we know what to look for, know some of the pitfalls that can certainly occur. Now, with that in mind, feel free to ask questions. There should be plenty of time as we go throughout the presentation or at the end. If we save up the questions for the end, Big Mike will be monitoring the questions as they come in. If there's something that you really want to know, by all means, don't hesitate to send it in. It is a bit different way. It is a bit different way to look at the markets. Really looking forward to our discussion today. All right. We're all traders. I've traded before. Most of you have traded before or are interested in trading, or you wouldn't be on this webinar. So, what we want to do is to better, and the last, say, 8 to 10 years, commodities have just exploded as far as popularity in the trading community. And so, to better understand, or to put better trades on, we need to be able to understand what type of markets that we're dealing with, and to do that, we have to winnow down. We have to, just take as few factors into account as possible. And I've done that in my analysis. It certainly helps me throughout the day looking at different markets, from the grains to the softs to the metals to the energies, wherever we want to look. The theory or this method is the same, to try to understand what we're dealing with. What type of market is in front of us, and what opportunities does it present? Okay, the very first thing we have to know about any market that we're dealing with is its structure. Now, there could be others out there that use structural market analysis in different ways. To me, what we simply want to know is the two legs or two sides that any market has, and that's the investment activity, how much money is coming in, what direction is it going, and the market's view of fundamentals. As we go through this presentation, you will realize that the question of fundamentals is very important, supply and demand. But there are different ways of obtaining the information that we need to become better traders, to better understand, what forces may be pushing the market one way or the other, or attracting some of this investment money that we're talking about. Other things that I look at is volatility, and that's how far and fast the market can move over a particular period of time. And this volatility does have seasonal tendencies in the grains. As we get here into the summer, we see the weather becoming more of an issue. That tends to increase volatility, while over the winter time, when there's not as much going on, volatility comes down. Volatility, as we'll talk about here in a little bit, is very important to investment traders. Usually, the higher the volatility in a market, the fewer investment traders there are. You will see investment traders start to leave markets that become incredibly volatile because it increases the risk. So understanding volatility is certainly a key. Look for the markets that have some lower volatility or at low volatility levels to view those as opportunities. Start to see some money moving into there, then the volatility starts to pick up. So we look at the structure of the market, we look at how volatility could certainly affect the money coming in and out and the overall risk involved. Then there's basis. Now, basis is generally viewed as a grain issue, and this is the difference between cash prices and futures prices. But it also holds true for markets such as crude oil or some of the metals markets. Basically, any storable good that you can have a cash market for that also has futures traded on it will have some price differential between its cash and the futures. And the stronger that price relationship is, the stronger the cash is to the futures market, then the stronger that market is fundamentally. It's another read on fundamentals that can go along with the other signals that we're looking for, the other type of market factors that indicate to us whether or not we're dealing with bullish supply and demand, bearish supply and demand, or something else. Again, basis can trend. You will see that that's a familiar topic, a very familiar, popular topic as we go through this presentation, and it too can have seasonal tendencies. Now, when I talk about seasonal tendencies, historically, markets have had, and again, this is predominantly in storable commodities, but can also include things such as, say, livestock, or not as much metals to a certain degree. We could do some work on that. Never have seen anything conclusive. But when I talk about seasonal tendencies, historically, there were times of the year, either a marketing year or a calendar year, when fundamentals would sway prices one way or the other. A classic example is in the energy market, where both crude oil and let's say RBOB gasoline would see an early winter low, say in early February, something like that, and then basically trend up in price, both cash and futures, up through the July 4th holiday peak, and then start to come down. Now, the underlying fundamentals in that was we would see buying going into the spring and summer driving season. As we got to the 4th of July, most people had done their vacation, so on and so forth. The idea that demand was going to start to slow, hit the market, prices started to come down before establishing their next low the following winter. So, most markets have these types of seasonal cycles. But an interesting change has occurred. I mentioned earlier that over the last 8 to 10 years, we have seen a change in the markets. We've seen a change in the dynamics of the markets because commodities in general have become such a popular investment avenue for international money to move in and out. It has changed the seasonal cycle. Sometimes fundamentals get completely set aside, more, with factors like volatility, with other issues coming into play. And it's changed these seasonal cycles. We don't see these same patterns that we used to see. So I find it a very interesting development, and it's kind of pushed the seasonality factor down the scale a little bit to where we don't use it as much as we used to. It's still kind of a guide, but it's just not quite as reliable as it was in years gone by. Last but not least, there's price. And again, the old, you want to try to buy low, sell high, all of these sorts of things. Well, that's true to a point, so knowing where you were in the historic price range is very important to understanding, is this market overbought, is it oversold? But the issue now is, and what we've seen basically since 2008, where many commodity markets, energies, grains, softs, so on, have gone to new highs, is how high is high? How much higher is large-scale investment money willing to push a market before they determine that the market is overvalued? So we can't really go by historic price levels. So these have changed as well. Prices spend far more time up in these upper ranges that have been established, forgetting the lower ends. And even if you use, say, a 5-year scale, we're still looking at very wide price range. So these last two factors, while still important, just aren't quite as important as they used to be. Now, for today, we are going to be talking about market structure, because to me this is where it all starts. If we can understand a market, we can start to position ourselves, and we can then use the other filters, the volatility, the basis, the seasonality, the price, where we are in the price distribution range. We can start to use those as filters for, okay, this is a better opportunity for me, this is not a good opportunity for me, but it all starts with market structure. All right, again, every market has a structure. I don't care what market we're talking about, particularly in commodities. If it can be traded, it has a market structure. And market structure is based on, number one, the trend of the futures market. All right, I'm interested in, and when I say trend, so many people think automatically that this is nothing but technical analysis. No, what I'm looking for simply is price direction over time. How is this market moving? Because what direction is this market moving? Because that tells me what the flow of non-commercial money is. Now, when I say non-commercial, and I'll use that term a lot, I'm talking about investment traders, I'm talking about fund traders, and this can be either the hedge funds that we've seen pop up predominantly here over the last 5 to 8 years, traditional commodity funds, any type of trader who is not specifically or not actually involved with the underlying cash market. Those traders are the commercial side. And so while I look for the trend of the futures market to indicate to me what the investment money is doing in these markets, I look at the trend of the futures spreads to tell me what the market's view of supply and demand is. And this is different than what many of you may be familiar with. Some of you, possibly all of you, know fundamentals by private studies that are out there, government reports, be it the EIA with energy, USDA with agriculture, whatever other markets or government reports that come out that you use as some sort of fundamental guidelines. My approach looks at or takes the idea that the market itself has a better idea. The commercial traders, those who are actively involved in the underlying cash market, have a better idea of what the true fundamentals are than anything we will see in a government report, and they reflect that in how the future spreads are traded, how contracts are priced, how particular contracts of a commodity are priced against each other. That's the key. That's what we look for. That's how we know whether or not we have too much supply to meet the demand, or demand is picking up and maybe supplies are coming down. These are the keys that we look for, and these are, and this is the factor that can start to swing that first side, that can start to sway or influence the first side of the market, the investment side of the market, because often investment traders, not only are they looking for a low volatility market, they are looking for a market that shows the promise of bullish fundamentals to come, meaning supply demand is getting out of line to the side that prices are going to have to go up to start to ration demand. This combination of trends, again, trends of the futures market, trends of the future spreads, results in 9 different market types. So, if we take all of the different types of trends we can have from futures market and future spreads and we combine them, then it gives us this table that tells us there are 9 different market types. So let's just quickly look through a couple. And again, if you have any questions about any of this, don't hesitate to ask. Let's say we have investment money coming into the market. And that means we've got an uptrend going on. That means that the investment side or the non-commercial side is bullish. All right, they think the market's going to go higher. Now, let's also say that the future spreads, not only the trend of the future spreads, but how the different contracts relate to each other, let's say they're also bullish. That would give us a type 1 market. We see some of that going on today in various markets. Certainly one that would be, let's look at the other end of the spectrum where investment money is coming out. We've got a very strong downtrend going on. We also have fundamentals that really aren't providing much support, at least the market's view of fundamentals. That would be a type 9 market. Anybody think of what that might be? Take a look at gold. What's been going on in the gold market? It's a collapse. Nobody wants to keep their money in there. Yeah, it was, let's take a look at it today. Yeah, it was down another $30. Now down another $30, down below $1,200 right now. Why is that? Nobody wants to keep their money in it. Investment traders are getting out. Fundamentally, there's no reason to continue to put money in. It's bearish as well. We have a type 9 market. So anywhere between that spectrum, between both sides being bullish and both sides being bearish, we have a total of 9 different markets. So, understanding how these two sides go together, what types of market these two sides create, is key to being able to stay in step with, stay in step with the market and put on better trades and be in better positions when all's said and done. All right, let's change pages here. Get out of this. Pardon me just a second. Trying to change pages here.
Sorry, I thought it was escape. I guess it's not.
Oh, maybe it is escape. I apologize.
No?
Nope, there we go. Sorry about that, folks. All right, so now let's look at the trend of the futures market and the future spreads. Again, what is trend? Trend is simply price direction over time, and it can be one of 3 different directions. Up, which is bullish. So in other words, money's coming into the market, prices are being pushed up. That's a bullish sign. That means traders generally think this market's going to continue to go up, but the opportunity is to the other upside. In the case of gold, we can see a downtrend just as well. That means money's coming out of the market, or traders are actually building short positions and pushing the market lower. So that in a downtrend, that would say that the overall investment view of the market is bearish. We can also move sideways, all right? That's just viewed as, and sideways is an actual direction. So that's viewed just as a neutral opinion to the market, meaning they're taking more of a wait and see approach. Crude oil, gasoline, heating oil for that matter, have all basically been caught in these sideways trends. Nobody really knows which direction to go. There's so many questions out there. What's the Fed going to do with interest rates? How's this going to affect the dollar? How's that going to affect commodities, key commodities such as crude oil, gold, and some others? So they're taking a wait and see approach, and we'll see more of that in some charts as we go along. But for right now, crude oil seems to be caught in this sideways trend, but we can still look at that. Remember, we've got 9 different market types, and some of them include, if we buzz back, some of those include having a neutral view. If we look at the type 4, type 5, type 6, or even on the commercial side, if we look at a type 2, type 5 market, type 8, we can. A neutral reading in either the trend of the futures or future spreads still gives us all kinds of information we can use and helps us to position ourselves accordingly. So, we do have 3 different types of directions. Now, we also have 3 different time frames, and depending on basically how you like to trade, whether you're a short-term trader, whether you're a long-term trader, you can break the trends down into 3 different time frames. One is short-term, and I always phrase those as minor trends. Usually those show up on the daily or shorter chart. So if we're looking at price direction over time on a daily chart, or say an hourly 5-minute tick chart, whatever it might be, that would be classified as a short-term or minor trend. Intermediate term, that's what I call a secondary trend. These are usually what I see on the weekly charts. And this is what I use most often. As we go through the charts, you'll see most of them are weekly charts showing me the intermediate term or the secondary trend. Now, the reason why I do this, and a lot of people still use day charts, but we've seen so many changes in the trading hours that at one point when we had 21-hour days, particularly in the grains, there really was 21-hour trading days. There really was no break. All we saw was an intermission, and so a week was just a long, extended day over the course, say from Sunday evening through the close on Friday. So, I've always looked at weekly charts, but those changes seem to even highlight how much more important the weekly charts were. Day charts might be too short. Long-term, major monthly charts possibly too long to establish ourselves in trades. They're all useful. They're all useful for different things. But for getting, I think, a clearer picture of the market, often I will just continue to focus on those intermediate term trends that show up on the weekly charts. All right, here's a look at crude oil. All right, I already kind of tipped it off by saying when I was talking about sideways trends that crude oil seems to be caught in its secondary trend. Certainly seems to be sideways. And as you look at this, from its recent high from back in 2011, this isn't going all the way back to 2008. We'll talk about that later. But from its high in 2011 of just short of $114 down to its low in late 2000, or in the fourth quarter of 2011, down around $79.20. Wide range, I know. We're looking at, what, $33, $34 range in there. The market really has just continued to see a smaller difference between highs and lows. We'll move up for a little while, like we did when we got up to about 110 in about early 2012, first quarter 2012. Then we came right back down through the middle part of 2012. And we just keep tightening that range ever so slightly, hovering near that that midpoint of that longer term, of that initial sell-off, at least on this chart. So I find that interesting in the fact that crude oil over the last couple of years just has not been able to break out of this range. Why is that? Well, number one, we haven't seen a lot of fundamental reason for the market to get overly excited. We had the huge run back in 2008. We followed that up with some different market directions, and now we are just consolidating, waiting for that next big breakout. But also, if I throw in the CFTC report every Friday, includes or shows the different holdings of a variety of trading classes. What we do here at DTN IQFeed, ProfitX is one of our systems that we have, is we can chart what those different groups hold each week when those reports are released. This chart shows the blue columns, or the blue histogram on this chart, is the non-commercial net future position. So in other words, we take the longs that the non-commercial holds, the positions that they've bought, and we subtract off the positions that they've sold, and that gives us the net. Now, the red line, that is the weekly close for the spot month crude oil contract. Now, I never look for perfect correlations in the world of commodities. There is no, truly givens. There is no such thing as a perfect correlation. But when I look at this chart, or when I look at the chart of any commodity in relation to weekly closes and CFTC, either non-commercial long or non-commercial net, you can use whatever you like. In this case, I'm using a non-commercial net. When I look at those two, there's usually a very strong correlation. In this case, as you can see by our study in the box, it's almost 67%, just short of 70% correlation. And that is probably stronger if you take into account, thanks to good old government reports that are always delayed, the information's always old. Weekly CFTC reports come out on Friday afternoons, commitments of traders reports come in on Friday afternoons, but the positions are as of the previous Tuesday. So we have 3 days there where the markets are moving towards a weekly settlement that aren't accounted for in the report. So my thought is that the correlation is actually tighter than this near 70%, but this is what we see. This is what we have right now. And it still shows a strong correlation. It still backs up that when we see the money moving in, let's say like we did through from, say, late 2011 to early 2012, there was the rally that we got. And we talked about the sell-off that occurred from that up around 110 back down into the mid to upper 70s. Look at what happens on the blue histogram. Money is coming out. So the weekly closes fit very closely with what we see in the histogram as far as the position. Now, I know a lot of you have looked at many charts in your days, and you look over to the far right-hand side, and you see, okay, this non-commercial net position is starting to grow, but yet the futures market isn't responding. And that's interesting to me. Yes, crude oil is probably, I think as we look at this, what it's saying is if we go back to that seasonal tendency where energy complex tends to rally from the early winter up through, say, midsummer, there was some people, there was some investors, making that bet that that was going to happen. It just hasn't yet. We've seen some fundamental reasons why it hasn't happened. We've seen, the dollar reacting in certain ways that's cooled buying interest to a certain degree. So we're going to watch this as the summer progresses. By and large, still, yes, there's a strong correlation between the non-commercial buying, non-commercial net futures position, and the direction of the futures market, even though we're not really seeing it play out in the crude oil market, at least not yet this year. So the trend of the futures market. All right. Simply, if you want to remember this as the best way possible, the best way to think of trend is using Newton's first law of motion. It's what I've always used. Newton was a genius. Newton was obviously he was probably the greatest commodity analyst that ever lived. Didn't get credit for that particular role. But if we take his first law of motion, in physics that is, an object in motion tends to stay in motion until acted upon by an outside force. We all know that. We learned that years ago. But if we apply it to markets, it's the same. It's the very same thing. A trending market will stay in that trend until acted upon by an outside force. So once a market starts moving in that trend, be it up, down, or sideways, it tends to stay in that trend until acted upon an outside force. And we have to ask ourselves then, what is that outside force that can change the direction of a commodity market? Usually it is the activity of non-commercial traders. And again, we talked about commodity funds, hedge funds, index funds, global investment traders, whatever you want to call this group. That's the force. When they move their money in or they take their money out, that's what changes the direction of the market. That's the outside force that can create a different trend, create a new trend, move us in a different direction. That's why we follow it. And since the CFTC reports really aren't that accurate, aren't overly helpful, we just simply watch the trend. So if we see a market that's trending up, have a pretty good idea that's where the investors are moving. It's not a bad thing to be on the side of large international investment money rather than trying to fight against them. All right, so now we have to ask ourselves, okay, we've talked about trend. We've talked about the role of the investment community in commodity markets in any particular market. But how do we know the market's role, the market's opinion of fundamental? This has been a problem for traders forever. I've got a good friend right now. I've worked with him over the years. He moved from the analytical side of things into the trading side, and what he sees there is what we've always known as in existence, is that this reliance upon government numbers, government reports to tell us what fundamentals are. Well, to be brutally honest with you, government reports from any agency are flawed. They don't really know what the fundamentals are. if we want to have a better feel for what the long-term outlook is, whether or not we're dealing with bullish supply and demand, bearish supply and demand, we have to look for something other than government reports, and there's no better place to look than the market itself. And to do that, we have to look, or it's best to look, I've found over the years, at spreads. When I talk about spreads, it can be phrased that this is a technical view of fundamentals. Seems a little bit odd to look at it that way. Usually when we talk about fundamentals, again, we're looking at tables. Does column A equal column B, or is there anything left over, so on and so forth, yada, yada, yada. But no, what we're going to do is we're going to take a technical view of fundamentals to get a better picture of what the market believes supply and demand to mean. So right off the bat, what does spread mean? Spread is the price difference between contracts of a specific market. And again, this can be crude oil, corn, soybeans, distillates, gold, cotton, coffee, sugar, you name it. It's the same thing. Spread, the price difference between the contracts of any of these commodities, tells us what the commercial side, what the traders who are actually involved in that cash commodity, what they think the actual supply and demand is. So how do we read this? How do we read a market's opinion? Okay, we've got spreads. We're looking at the price relationship between contracts. This can be in a number of different forms. This can be, we can see a number of different things when we look at this. Number one is if it is inverted or it's in an inverse, often known in the New York markets as backwardation. This is where the nearby contract is higher priced than the deferred contracts. And this is a bullish view of the underlying fundamentals. So in other words, if we see, say, let me pull an example here. Let's just use July beans, priced at 15, just short of 15.5 right now, $15.50 per bushel. The August beans are at $14.32, almost $1.18, $1.20, almost $1.20 underneath the July. That is a very strong inverse. We have a very bullish commercial outlook towards the soybean market. All right. Now, if we have a contango, which is also known as a carry, so you have inverse and backwardation. You can have contango and carry. A contango is when you have a nearby contract price lower than the deferred contracts. That is a bearish view of supply and demand. This seems counterintuitive. Someone would say, okay, the market's saying it's willing to pay you more later, and that's bearish. Think about it. Maybe they're willing to pay you more later. That's one way to view it. But in reality, they're willing to pay you less now. They don't need the supplies right now. They've got plenty of supplies to meet demand, and so they'll pay you to not sell it now. That's a bearish situation. That's a contango, that's a carry, and a situation that we see that. Let me find a market here where we've got that particular situation. If we go off to, say, the wheat market, I was going to use something else besides grains, but that's the first one that jumps to me. At least that's the clearest one that I see right now. If we look at the Chicago wheat market, we've got the July contract trading 663. We've got the September at 673. The December at 689. So we have a bearish outlook for the wheat. Not surprising given the global wheat situation as it is today. So again, if we have a situation of carrying contango where the nearby contract's lower priced, that's bearish. If we have an inverted or backwardation situation where the nearby contract is higher than the deferreds, that's a bullish view of supply and demand. So what is the trend of future spreads? So now we've got the idea, okay, we've got how these price relationships fit. But now what about trend? How are these price relationships moving over time? If we see an uptrend on a spread chart, then that means either the contango is weakening or the inverse is strengthening. And that means there is a more bullish view of fundamentals growing in this market. That means the commercial side's growing more bullish, and sometimes that's enough to trigger another wave of commercial buying, of investment buying in the market. Now, if we see a downtrend on a spread chart, that means the contango or the carry is strengthening, or the inverse and or backwardation, whatever you want to call it, is weakening. and that's a more bearish view of the market. So uptrend, obviously, getting more bullish as we go along. Downtrend, getting more bearish. It means the price relationships are changing as such. The market's changing its mind. So again, we do have some very clear trends that occur in the spreads, not just in the futures of the market, but in the future spreads of a particular market as well. All right, here are some spreads in crude oil. The black line is the August SEP. We got a little box over to the right-hand side. Again, these charts are all available. IQFeed, DTN, Profit X. Our August SEP spread is off is on the black line, and what we see there, again, longer term, basically not going anywhere, kind of treading water, going sideways. But in the short term, we seem to be moving a bit down. Not that long ago, we were looking at about a 30-cent inverse. Then it dropped down to a 10-cent contango, carry, whatever you want to call it. Now we're sitting at about 5-cent inverse, near par. So the market has been seeing some movement, but now seems to be under a little bit of pressure. Spreads are trending a little bit down. But if we look further out, if we look out to the red line, which is the SEP October, or out to the blue line, which is the October-November, both of those continue to trend up, meaning the market has a bit longer term bullish supply and demand view of supply and demand. So some interesting developments right now. The one that jumps out to me is this nearby August SEP. Certainly going to keep an eye on that, and we'll see if any changes then start to occur in the deferred contracts as well, in the deferred spreads as well. All right. Change the page again. Nope, sorry. All right, another way of looking at the same information in a different format is through the use of forward curves. And what a forward curve chart does is it lays all of the contracts out on one chart. You can see the price relationship then. Again, so if we look at the first two, that's again the August SEP, and we see just an ever so slight inverse in that market, but the inverse grows steadily as we go out through the rest of the year, out through a good part of 2014. This would imply that the longer-term view, this confirms what we see in the spread trends themselves, that the longer-term view of the market, of the fundamentals of the market, is actually quite bullish. Something that we're really not picking up on in the market itself. Again, we've got a sideways trend going on here. So the question that we ask is, what's going on fundamentally that could be creating this view from the commercial side of the market? Number one is, the first thing that comes to me is that we're seeing more and more frequent bullish economic reports. Today's weekly jobless claims are just another example. They're not showing huge economic growth, but things are slowly building towards the bullish side, and a more bullish economy would certainly seem to be more bullish for the commercial, for the fundamental side of crude oil, as it could increase demand. Certainly supplies are not an issue, but it could certainly start to sway the market a little bit. That supply and demand could start to grow more bullish. So this is, again, it's just another way of looking at the big picture in market fundamentals. This doesn't show us the trend that I like to look at. That was the previous chart. But the overall picture of a market's view of fundamentals can certainly be shown with a forward curve chart. This is just a weekly EIA stocks report chart that seems to confirm what we see in the future spread itself. The black line up at the top, that's 2013 commercial crude oil stocks. Green oil, the green histogram is what we saw in 2012, and the 5-year average is the red line that cuts across the middle. Now, again, first thing that jumps out, we are not in a tight supply-demand situation. We've seen demand struggle since 2008 for crude oil. We've seen the spreads, for the most part, not really react all that strong. Right now, again, we're relatively neutral in this market, and that's, it pretty much goes along with what we see here, where we still have adequate supplies. We're just heading into a time of year when supplies start to pull down, from say late June through early August or late August or early September is when we usually see the markets draw down a little bit according to the red line. So we're just at a point where the supplies should start to tighten. And I think that's going to be reflected in, I think that's already being shown to us in the August SEP spread, trading in the slight inverse, and the deferred spreads holding a very strong inverse. But again, overall supplies still quite bearish, still have plenty of supplies on hand, even though that we're getting ready to head into a seasonal downturn. All of this information is available to us without knowing it by simply looking at the trends in the future spreads and the longer-term forward curve. All right. Now, what happens when the market opinion is divided? I threw this picture in of the sign of the Continental Divide. Recent vacation took us to Colorado, so I thought it appropriate to talk about what happens when we have two completely different views. So in other words, like the Continental Divide, one side water is going to run to the Pacific Ocean, the other side is going to run to the Atlantic Ocean. What happens when commercial and non-commercial traders do not agree on their view of bullish or bearish? Well, a classic example occurred in 2008 in the crude oil market. Again, think about what occurred back then. Seem to be missing a chart here. I must have jumped a chart. But anyway, if we just go back to this point here, let me get the highlighter. If we just go back to this point, back in June, July of 2008, when the market was rallying up to $140 per barrel, and at that time, the red line is the spread in the spot months contracts, and we were sitting at about a 30. We dipped back down to about a 15 to 20 cent inverse in the future spreads. Things were looking very bullish. We had money coming into the market. Bottom histogram shows that non-commercial money was still coming in. This is a non-commercial long. They were still buying in the market. Investment traders were quite bullish this market. But problems were starting to emerge. Notice on this middle study that the spreads had actually started to trend down, that the peak that we saw there in June, July as far as the spread was not as high as what we'd seen a few months earlier. We had turned the trend in the spreads down. The fundamentals, as the market moved higher, were growing more bearish. And this was a problem for the market. Money was still coming in, yet fundamentals were getting more bearish. So what was the end result? We can see that on the chart. After hitting its peak of 143, I believe it was, in August, we fell all the way back down to take out the July low, trading down to around 122, I believe it was, in August, closing lower for the month. And then by the end of the year, fundamentals were falling apart. And if we look down at the bottom histogram, money was pouring out of the market. Market bottomed out in the low 30s. A market collapsed. So we saw a divergence. We saw a divide between these two market groups. But it wasn't able to withstand, the investment side of the market was not able to withstand the sell-off from the fundamental side. So what we resulted in, a collapse. That's the usual reaction when we see a divergent market. It will tend to collapse, and that was certainly the case in 2008. Crude oil started by a change in the opinion of the commercial side, or the fundamental side of the market, when the future spreads started to turn down. So where are we today? Again, we talked about how this market is trending sideways. We're stuck right in here in the low 90s. Really can't move anywhere. The fundamentals, the middle line, again, the red line in the middle study, just trending sideways. There's no real opinion right now on the nearby future spread, yet money continues to come in. So it will be interesting to see if the fundamentals start to change to the point where we start to see an uptrend in those future spreads, start to give us an idea that the fundamentals are growing more bullish, and maybe that continues to pull more money in. So, conclusion, what did we see in 2008? Change in commercial outlook occurred before the change in investor action. And so this bearish change in the spreads that we saw it on the major trend, a key bearish technical signal emerged on the monthly chart after that, meaning that the market was getting ready to go down. As the nearby spread grew increasingly bearish, non-commercial long liquidation intensified, just speeding up the descent of the market. And then finally, in December 2008, the nearby spread seemed to stabilize at a strong contango. In other words, we had like a $4.5 difference between the nearby contract and the next deferred contracts, the spot and the next deferred, meaning that the spot was priced four and a half under the deferred contracts, meaning a very bearish supply and demand situation there at the end of 2008. But since then, we've seen the market stabilize, seemingly waiting for its next move. Now, another real-world example that we can look at is tomorrow's going to be an interesting day for grain traders. Not necessarily that so much for grain analysts, but certainly for grain traders. There is a quote-unquote key USDA grain report coming out. Not necessarily to me. I hold most USDA reports in very low esteem, but many will get excited over this. And this is the quarterly stocks of grain and the planted acreage update. Now, what is expected tomorrow? And what are the markets telling us? Are they the same? Is the market in step with what pre-report estimates are telling us these reports should come in at? If you want to see my full, if you would like to see my full preview of this report and everything we put together that's up on the DTN site today, you can certainly go to this website right here. It will be on the very front page. You'll see our preview, and you'll be able to see all we have to say going into this thing. And we will also have a post-report webinar starting at noon on Friday. If you'd like to join us again for that, you can look for the link on the final slide as we close out today's presentation. But here's the review table. Again, it doesn't really tell us much if we're not familiar with the history of this thing. But if we look, number one, at the corn acreage, the very top number, it's supposed to come in at 95.34 million acres compared to what we had in the March prospective plannings report, just short of 97.3 million acres. So we're looking for almost a 2 million acre decrease in corn. Yet on soybeans, expected to see a little bit of an increase. So we would assume then that the corn market, the corn report should be bullish and the soybean report should be bearish. And this is for the new crop market. Again, we've got, this is for the acres that are going in that are being planted right now that will be harvested later this fall. Now, as far as quarterly stocks, this is the other big part, and this is down at the bottom. We're looking at corn coming in at an average of just under 2.9 billion bushels and soybeans at 441. Again, to the casual observer, these don't mean much, but it's how these numbers fit into what we've seen previously as far as monthly USDA supply and demand reports, what it's implying for quarterly demand, all these sorts of things. Both of these numbers would be viewed as bearish, which is interesting if we start taking these markets apart by structure. Okay, first off, let's look at new crop corn. Again, top line is a simple price chart. That tells me that this thing's basically moving sideways. The green line on the second study, that's the initial spread, the D's to March. Again, a very neutral stance. So traders in both future spreads and futures markets themselves taking a wait and see approach. They're not as bearish as what maybe these acreage numbers, or as bullish in corn as what these acreage numbers would seem to imply. So we've got some things going on. The non-commercial position is the blue histogram there towards the bottom. And you notice that it's also stabilized. So that's not going anywhere. That's why we have a sideways trend basically going on in the December futures market. But notice the red line. That's the volatility, the fourth study down. That's the volatility. December corn has high volatility. And remember what we said. Non-commercial traders are leery about buying into a highly volatile market or a market that's showing higher volatility, particularly if the fundamentals aren't showing a turn towards being bullish. Green line being flat, still a little bit neutral, volatility going up. The market may be looking at this not so much as being bullish, but it's going to take something extraordinary to get investment traders interested. We'll see what tomorrow brings. Maybe by this time tomorrow, after the release of the report, after everyone's had a chance to trade, maybe this looks completely different. But right now, just not seeing the excitement build in corn. Soybeans, on the other hand, are a little bit different. Remember the quarterly stocks. I'm going to be looking at the old crop, the quarterly stocks number, because I think that's the one where USDA is really screwed up on. Look at the black line in the lower right-hand corner. That is the July to August spread. We talked about that earlier. When I put this together, it was around 104, 105, $4, $5 over the August. Now it's up around $10, $12 over the August. This thing is in a sharp uptrend. Combine that, or what that tells us is we have very tight supplies. That 441 million bushels is being expected in soybean quarterly stocks. Maybe USDA comes out with that. Probably will, something along that line. But the reality is the U.S. situation is far tighter than that. The ending stock situation in soybeans for 2012-13 marketing year that ends in August is far tighter than what USDA is saying right now, probably tighter than USDA's unofficial floor of 100 million bushels. Won't take its ending stocks below 100 million bushels. Will do whatever it can with its accounting to keep it above that level. Right now, market's saying probably tighter than that. So in the upper left-hand corner, what we see is investment traders are starting to buy back into soybeans again. So we have a very bullish market structure in soybeans in what is expected to be a bearish report. So it will be very interesting to me to see which side is right. If the traders in the markets actually have a better feel, or if the markets are more influenced by something something like USDA reports that come out to kind of squash things every once in a while. Conclusion to all of this is understanding how market structure works can provide us with a better idea of what type of market we're dealing with. Of those 9 different market types, what type of market are we dealing with? How do we position ourselves? Every market, again, has 2 sides. Flow of investment money sets the trend of the market, while commercial traders counter with moves in the spreads and their own trends, how they position themselves, how they move the spread market. In a market with divergent opinion, the commercial side usually wins. Doesn't always win. Sometimes the flow of investment money is too strong. It will take time, but usually the investment side of the market will cave in to a market with changing supply and demand, with fundamentals that differ from their points of view. And knowing the type of market, again, what's key to all of us as traders, analysts, whatever the case might be, is knowing the type of market that is in place helps us to establish better trading positions, and that's the key. We need to be in better trading positions. We need to be able to make the most of the opportunities as they come along. So I want to thank you for joining us today. Here's some information as far as my Twitter account, email. Again, that webinar that will be tomorrow afternoon after the report, at noon Central Time tomorrow after the report, and some information on the DTN IQFeed. Now, as I said at the beginning, Big Mike has been monitoring the questions as they come in.
Yep.
Mike, do we want to do the questions now, if there's any in, or do we want to do the prize questions?
Let's take any questions that are there, and then we can do the prizes. So,
sure.
So far, actually, there's not any questions. I think, first of all, I want to say that you really did a fantastic job. I really appreciate the time that you put into the presentation. And I think this is actually a really fantastic webinar that covers a lot of ground, so I want to thank you for that.
Well, I appreciate that, really do.
Okay, guys, so if there's questions, now's the time. So, Darin, I kind of wanted to ask you myself. You mentioned that you kind of lean towards weekly charts more.
Yes.
In your own trading, do you primarily consider yourself a swing trader or a day trader, or how do you classify yourself?
More of a position trader. So I would be looking at doing longer, or I guess it would be the secondary positions, where I don't necessarily want to be jumping in and out. What I'm looking for are these changes in trend, changes in market structure, and then positioning myself accordingly. So if there's a way that I can use this to be in a bit longer term. I don't really want to get caught up in the getting into commodities for years on end.
Right.
Commodities were not set up that way. Very dangerous sometimes to try to make an animal something that it's not. And commodities simply are not a long-term trading vehicle without changing your mind here and there. So I would say more of a position trader rather than a day trader. I've done some of that in the past, but I would be more looking at intermediate term positions.
So let's say that hypothetically you wanted to take a position on crude. Mm-hmm. How do you handle the front months? Do you normally what do you start your position from? Do you do it in the current contract and then roll it over, or?
Yeah, a lot of that depends on what the spread structure, what that forward curve is. And so when I see that the longer term, we've got a bullish supply and demand situation where we've got an inverted market, I would be more prone to stay near the front months because, again, an inverted market means that we have a tight supply, that we have some sort of situation brewing in the supply and demand where commercial traders are going to be pushing the nearby contracts.
Right.
So if that's the case, I want to try to ride that up by being as close to the spot as I can.
Okay. Okay. Let's see what other guys are asking. So Tim is asking, do you have any thoughts on using spreads in the currency markets when there is very limited open interest in the back months?
A little bit difficult. Certainly spreads can be used in the currencies, but you touched on the key point. The further out you get in almost any market, you're going to be dealing with some open interest and volume issues. And so if you go out to a currency that has very low open interest or has very low volume, you could have, number one, not only is it not as good a read on possible fundamentals or possible long-term views of the underlying fundamentals, such as interest rates or for a particular country or whatever might be moving that particular country's currency, you're not going to get as good a read on it when volume and open interest is quite low. So you could certainly use the same method in currencies, probably stick towards the closer months to get a better idea. Certainly not saying you can't do it further out, it's just more difficult.
Okay. Also, I noticed that you were plotting a symbol for the commitment of traders numbers. Is that something that's available on, is that part of the regular IQFeed package, or is that an extra option?
You know what, the system I have, the Profit X, certainly has it, and I believe, and Robert could correct me if I'm wrong later, but I believe that's on IQFeed as well.
I'll pipe in. Here it is.
Yes.
It's available for IQFeed as well.
Okay, great. Let's see. CB is asking, he says, you said that there's, in the inverse situation, that there's nearby contract is higher than the deferred contract, and it would be bullish in that situation. Can you explain why that's the case?
Yeah, that's a bullish situation because, again, you have the commercial side of the market. You have merchandisers. You have petroleum companies, whatever the case might be, pushing the nearby contract. So let's say we're pushing the August versus the SEP or whatever the contracts we're looking at, but we're pushing that nearby or spot contract versus the others, trying to, number one, source supplies to meet demand or ration demand. So the stronger that nearby contract is in relation to the deferreds, particularly if it's priced over the deferreds in an inverted situation, the more bullish the underlying fundamentals of a market actually are.
Okay. Futures operators asking a question. It's a venturing a little bit off topic, but more about your own personal trading. He's asking just a general question about managing risk when holding positions for a longer period of time. Do you have any like hard fast rules that you follow, like your targets always have to be bigger than your risk, or do you place stops at fixed amounts, or is it based on recent prices? How do you personally handle that?
As one of the first slides told us, I used to use a bunch of different filters, saying where we are in the price range, are we overvalued, undervalued? Volatility is certainly one of those. As volatility goes up, I realize that the risk is also going up. Then there are some technical signals that I look for. Now, I'm not a huge believer in this day and age of computer algorithms that technical signals are as valuable as they once were. But if we go back and we look at that 2008 crude oil chart, certainly that key bearish reversal on the monthly, we see these pop up on the weeklies quite often. We see them, either bullish reversals, bearish reversals, whatever the case might be. So sometimes I will look for a technical chart and help to kind of set the parameters. Now, when I'm targeting particular prices, I use a system of retracements. In other words, you saw some different levels in there, some different charts that had retracement levels. I use a combination of Dow theory, which is the classic 3350 and 67%, in some markets, where I've changed more to Fibonacci in the others, using the 31.850 and 62 Probably got them wrong in there, but anyway, the Fibonacci numbers at retracement levels, because those seem to fit in better with what algorithms are based on. And the number one rule that I have is to stay in step with the large investment traders. So, you know, if they're using some retracement targets based on Fibonacci, then I'm certainly going to change my thinking, my programming along the same way. So while the long-term trend may be down or short-term retracement may be taking us up, so I'll target a price up there, again, depending on what the fundamentals are telling me. If it's a neutral to bearish fundamental reading in the market, I may be only looking for, say, a 31.8 to 51%, 50% retracement, where if I'm getting a more bullish read on the fundamentals, then I may be looking at that 50 to 61.8% retracement. So I'll set my targets that way. In a market where we're clear to the previous highs, basically you have to be very careful on where you set your stops. Stops are a terrible way of backfiring on you, but then use the volatility, use some momentum indicators to tell you when the trend of these markets may be changing, when the flow of money might be looking to make an exit,
right.
Without really having a CFTC report to help you.
Okay. So, on my personal list of things that I'm trying to make time for in my own trading, the COT report and incorporating some of that has been on my list for a long time, and I struggle to get to it. So my understanding is that the report is based on, like, let's say you're looking at the S&P 500, it's per front month, right, per contract. So do you need to combine the current month along with the future months in order to get a big picture, or is the volume so low in the deferred months that it doesn't really matter?
In something like the S&P, I'm going to say that the deferred months, where most of the investment activity or most of the activity in general is up in the nearby, that you don't really have to worry about the deferred contracts all that much.
Okay.
It's different for each market. Each market's going to have their own personality. Crude oil is going to be different than softs, which are different than financials. So.
Right. Like crude, when I used to trade it, I think I noticed that there was quite a bit of activity on the December contract each year. So
Exactly. So you kind of get used to where those larger volumes are, larger open interest. So in some of these storable commodities, then the commitment of traders report is possibly a bit more useful, because it does give you a bigger picture of what the total open interest might be.
Okay. Let's see. Tim is asking regarding ETFs. Well, he says commodity ETFs typically use futures and report directly to the CFTC for the COT report, or he's asking, or do they typically trade through intermediaries like banks that then report directly?
I have to be honest, I don't know exactly how to answer that question. I apologize for that, but I'm not completely sure of how they do that.
Okay.
And I don't want to be misleading in any shape or form.
RR is asking, how do you track the movements of the larger players or funds? So, I guess maybe he's asking other than the COT report.
Yeah. COT, I usually only basically confirm what I see on the spreads. It's not on the spreads, but on the trends of the futures market itself. So the way I track the funds is what direction is the futures market moving, and then if when the COT is released, even though it's for the previous Tuesday, I look to make sure that it's still a relatively good fit. And if it's not, like we looked at in the crude oil right now, that means there's something brewing, something that I need to be a little bit more cautious with or conscious of. If we start to see the CFTC positioning start to pick up on the Friday reports, yet the futures market isn't going anywhere, we're going to want to do a little bit more research.
Right.
But if we've got them moving pretty much hand in hand, the only thing I'm really going to look at is the trend.
Okay. So if I remember your slide correctly, crude has been near I guess like a triple top area for a little while in this range, but I think the COT report showed a new influx of money. Is that right?
That is correct. That's
okay.
correct, and that's why it really needs to be looked at carefully.
Right. Okay, so I don't see any of the questions on the screen. So, guys, I just want to remind you that if you do have questions that you didn't get answered, you can contact Darin. Right there is his email address and his Twitter. You can also go to IQFeed.net. All right, so you want to go on to the prizes?
Certainly.
Okay, guys, so what we're going to do is Darin's going to read the question, And if you're one of the winners, I'm going to ask you for your BMT username, and then I will get a hold of you once the webinar is done so we can get the prize in your hands. And the prize today is we're giving away, DTN is giving away four prizes, and each of those is for a 4-month subscription to IQFeed. Did I get that right?
Yes, I believe so. 4 months of free IQFeed. That is correct.
Right. Okay, let's do it.
First question. According to the presentation, how many market types are possible? And this will go to the first correct response.
Right. And we got the answer. CBE, I need your BMT username. So the answer is 9, correct?
That's correct.
Okay. And you also just pointed out, so when we go to question 2 here in just a second, we're going to be looking for the second correct answer. So keep that in mind, guys. Okay, go ahead.
All right, so the second one will be the second correct answer. And the second question is, the movement of investment money directly affects a market's what?
Okay, we've got it. So looking for the second right answer. The answer is trend. And Franz, I need your BMT username, please. And write that down. Okay, I recognize that. You've won a couple prizes this month. Good job. All right, number 3.
All right, 3. The notes I have, this one goes to the 6th correct response. We win 4 months of free IQFeed. And the question is, an inverted forward curve means the commercial side of the market holds what view?
Okay, we've got it. So let me find here. 1, 2, 6. Mr. E, is that your BMT username? So the answer is bullish, or bullish fundamentals, bullish supply and demand.
Mm-hmm.
Okay, so let me write down that username. Okay, number 4.
All right, and by my notes, this would go to the 10th correct response, and that is when the nearby contract is priced lower than the deferred contracts, the spread is said to be in what?
Okay, let's see. I'm going to make sure we've got 10. I'm pretty sure, but I'm just going to hold off for just a second to make certain. 3. Yeah, I got to count to see.
Sorry.
2,
I'm
3.
sorry.
It's all right. It's all right. It's all in good fun. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. Okay, good. We got it. So the answer is Contango or Carrie and Christina. I need your BMT username. You got that one. All right. So congrats to the winners. I will get a hold of you in just a few minutes when the webinar is done, and I'll get you that. Get the info so we can get the prize in your hands. And okay, so I got the username. All right. So once again, Darin, I really want to thank you and appreciate your time today. I look forward to having you back if you'd like to come back.
Thank you for having us today and for providing us the opportunity.
Sure, absolutely. And Robert, thanks again for helping us and helping Darin to come and do a presentation for us.
It was my pleasure, and again, congratulations on 4 great years. I know there'll be at least 4 more. I hope to be around to help them too.
Absolutely. All right, guys, I'll post the recording of this on BMT sometime tomorrow, and I'll see everybody on the forum. Thanks, guys.